Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 13th of November. I'm Daniel Lam, your host for the podcast. What is the Fed going to do in the December meeting? That has been a popular question during my client meetings. Now, the market is currently pricing in slightly higher than 60% chance of a 25 basis point cut at this December FOMC meeting. Now, this probability has dropped from last month following the October FOMC meeting when Powell pushed back against more aggressive easing. So the 10-year US government bond yield has also risen from a low of 3.95 to close to 4.2%, but it has been coming off slightly lately. Now, of course, recently in the US, we have been working mostly off the private data. Macro momentum is staying neutral, with the latest ISM manufacturing PMI showing stabilizing but weaker growth. The headline index missed expectations and continued to signal contraction. But new orders, which usually lead the headline, improved. Regional Fed manufacturing surveys also point to improving new orders, reinforcing the picture of tentative stabilization. But inflation is still relatively sticky and is above target, and good economic news can be read as bad news for risky assets, as stronger growth would reduce the need for Fed easing, which has been one of the key factors supporting equities in offsetting slowing growth and employment. Now remember this statistic. Historically, the S&P 500 gave an average of 17% return over a period of 6 months from the date of the first Fed cut under non-recessionary scenario, i.e. soft landing. Hence, mildly weak data will be most welcomed by the markets. That is a quote-unquote happy medium. Not so weak to trigger fears of recession, and still enough to keep the Fed going for further rate cuts. This is the kind of macro data that we've been getting, and we're still projecting a 25 basis point rate cut in December, followed by 3 25 basis point rate cuts in 2026. Now, of course, on the micro side, it has been supportive. The company's earnings and guidance in the US have remained strong, and that justified our overweight stance in US equities. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.